1.2.1. Meaning and definition of financial management. First, let's understand the heading meaning. Meaning, what is financial management, basically? Definition, what experts said officially about financial management? Meaning of financial management. Financial management equals managing the money of the business properly. It means getting money, using it smartly, and keeping track of how it's being used. Financial equals finding, collecting, and using money. Management equals planning, organizing, controlling everything smartly to reach goals. So, financial management, handling the company's money matters in a smart and planned way. Simple definition in easy words. Financial management is the part of business where we carefully plan, arrange, use, and control the money so that the company can grow and achieve its goals. Definitions by experts, little simpler without changing actual meanings too much. Solomon's definition. Financial management is about using an important resource, capital funds, efficiently. Simple. Smart use of companies' money is what financial management is about. J.F. Bradley's definition. Financial management means wisely using capital and choosing where to get it from so the company can move towards its goals. Simple. Spend money wisely and choose good sources of money for business success. Howard and Upton's definition. Financial management is applying planning and control to finance activities. Simple. Plan well and keep control over all money-related work in business. Weston and Brigham's definition. Financial management is about making financial decisions by balancing employee needs and company goals. Simple. Take smart money decisions that keep both employees and company happy. Enghacha examples to understand easily. Example 1, bank PO related. Imagine you are a bank manager. You have to plan how much loan to give, organize collections, control expenses of your branch. This smart handling equals financial management in action. It's example 2. Simple. Suppose you earn $10,000 per month. If you plan how much to save, how much to spend, and where to invest, you are doing financial management. Key points you should remember. Financial, money-related, management, planning, organizing, controlling. Finance smart handling of business money to achieve goals. Main focus, efficient use of funds, and proper decision-making. Important for growth and success of business. Summary. Financial management is managing the company's money very carefully and smartly so that the company can achieve its goals. It involves planning where money comes from, how it is spent, and how it is controlled. Famous experts like Solomon, Bradley, Howard Upton, and Weston Brigham have explained it in slightly different but similar ways. How it helps you in real life, bank PO, interview, MBA, career. Bank PO exam, interview. They may ask you, what is financial management? Now you can explain easily and impress them. Group discussions. If a GD topic is about business or banking finance, you can use these points smartly. Internships, jobs. In banks or companies, you need to manage budgets, costs, loans, investments. All need financial management knowledge. As a future manager, you must decide where to invest money, where to spend less. This needs strong financial management skills. Done! Ready for your next concept whenever you send it. Please send the next topic from your book. I'm ready to continue like this. 2. NAP 1.2, Evolution of Financial Management. First, understand the heading meaning. Evolution equals how something changes, improves, or grows over time. Financial management equals managing money smartly for the company. So here we will learn how financial management developed over time. Full explanation in simple words. In the 19th century, financial management started becoming very important in business. It didn't happen in one day. It evolved through 3 major periods. 1. Traditional period, old style. Focus was only on big events like mergers, reorganizations, and expansions. It was more about legal rules and business formalities. Financial decisions were mainly controlled by outsiders like lenders, banks, regulators, and investment bankers. Companies were not fully controlling their own financial decisions. They listened more to outsiders. Example: imagine an old-time company like a bank wants to merge with another bank. All the focus was just on getting legal permission, arranging money, and following government rules. Not much thinking about how to grow profits creatively. 2. Transitional period, changing phase. Slowly, financial management started to look inside the company. They began doing fund analysis, checking where money is going, fund planning, planning future money needs, and fund control, watching if money is being used properly. Financial planning became part of daily business. Example: suppose your bank branch starts checking every month where the money is spent, how to plan the next month's budget, and how to control costs. That's transitional phase thinking. 3. Modern period, today's style. Financial management became very smart and scientific. It started using economics theories, statistics, and mathematics to make better decisions. Focus shifted to optimizing money usage, best use of available funds. Forecasting, financial modeling, and risk assessment became common. Key characteristics of modern period. I. Macroeconomic changes. Due to global economy changes, companies now think carefully where every rupee is spent. I. Multidisciplinary approach. Now financial managers use math, statistics, economics to solve money problems smartly. Example: imagine as a future bank manager, you use data analytics to check which customer type takes loans and repays well, and based on that, you offer special loan schemes. Modern financial management in action. Key points you should remember. Traditional period, focus on legal matters and big transactions. Transitional period, focus on planning, analyzing, controlling funds. Modern period, focus on using economics, maths, forecasting for smart decisions. Today's financial management equals very scientific, analytical approach. Tash summary. Financial management evolved in 3 main stages. 1. Traditional period, focused on big legal events. 2. Transitional period, started planning and controlling funds. And 3. Modern period, uses scientific tools to manage money better. Today, financial management is highly important and needs sharp skills in planning, forecasting, risk management, and optimal fund usage. How it helps you in real life: Bank PO, interview, MBA, career. Bank PO exam, interview. In interviews, if asked about financial management history, you can explain the 3 periods easily and impress. They may also ask how modern techniques help in banking. And you can smartly connect it with today's banking analytics. Group discussions. If a GD topic is about evolution of banking or financial innovations, you can explain how finance evolved with time. Internships, jobs. In banks, you will use forecasting, risk analysis, fund control, all modern financial management concepts. As a future manager, you will make financial decisions every day. Managing loans, deposits, costs, profits, everything needs modern finance skills. Done. Ready for your next in the detailed, full emoji, simple, exam smart way you want. 1.2.3 Scope approaches of financial management. First, understand the heading meaning. Scope, what all activities and areas financial management covers. Different styles or ways of thinking about financial management. So here you will learn how financial management's activities changed over time and how different experts viewed it. Full simple explanation. Financial management started with a small role, just getting money. But over time, it became a big important field involving money planning, investing, saving, and using it wisely. There are 2 main approaches. Traditional school of thought, modern school of thought. 1. Traditional school of thought, old way. In the traditional view, financial management had a very narrow role. It was only about getting money for the company, no focus on how to use that money. The finance manager's job equals arrange funds when needed, nothing more. Managing funds, how money is used, was done by others, not the finance team. Scope in traditional approach. I, assessment of fund requirements. Find out how much money is needed. E, procurement of funds. Borrow from banks, investors, financial institutions. E, issuing financial products. Selling shares, bonds, debentures to collect money. I've managing legal framework, following rules for financial transactions. Limitations of traditional approach. Why people stopped liking it later. I, outsider's view. Finance decisions were seen from outsiders like banks or suppliers, not from the company's inside view. I ignored daily financial problems. Only thought about big events like mergers, ignored everyday cash flow or bill payments. EI ignored small businesses, focused only on big companies, not on small shops, partnerships, or individual businesses. IV ignored working capital, only cared about long-term money, ignored short-term money needed for daily operations. V ignored how to spend money, only focused on how to collect money, didn't think how best to use or allocate it wisely. Important note, Solomon described scope like this. Should a business start a project? Compare expected profits with required returns? Find cost of capital. Choose right mix of loans and shares? Useful for your interviews. Remember this for Bank PO, GD, PI. 2. Modern school of thought. Today's way. The modern approach is much bigger and smarter. Finance management is not just getting money. It's also about how to smartly use money. Finance team does analysis, decision-making, planning, and controlling funds. It solves 3 big finance problems. Okay, 3 main problems solved in modern financial management. I, investment decision. Where should the company invest its money to get maximum profit? Example, a bank decides whether to invest more in home loans or business loans. Financing decision. How should the company raise money? Through loans, shares, bonds. Example, SBI Bank decides whether to issue bonds or take a loan. The dividend policy decision. How much profit should be shared with shareholders and how much should be saved for the future? Example, after earning profit, a bank decides how much money to give as dividends to its investors. Viv, liquidity decision. Keeping enough cash ready for daily needs and emergencies. Example, bank ensures enough cash is available at ATMs. Key points you should remember. Traditional approach, focus only on getting money. Modern approach, focus on getting and using money wisely. Modern finance handles investment, financing, dividends, and liquidity. Modern finance equals scientific, analytical, and decision-based. Summary. Financial management scope has grown from just arranging funds, old traditional way, to smart investing, financing, dividend, and liquidity decisions, modern way. Today, finance managers analyze, plan, decide, and control money like true leaders. How it helps you in real life. Bank PO, interview, MBA, career. Bank PO manager role. In a bank, you must plan loans, decide interest rates, manage working capital, invest bank's money smartly, exactly like modern financial management teaches. Interviews, group discussions. If asked, what is the role of finance today? You can confidently explain modern approach, investment, finance, liquidity, dividend. Internships, jobs. You'll be working on investment plans, fundraising decisions, cash management, all covered under modern financial management. Real banking work. As a future manager, you will control money flow, working capital, customer loans, deposits, so knowing the modern scope makes you interview ready and work ready. Done with full detail. Step. Meaning of heading. Functions of financial management. Functions simply means important jobs or duties. A finance manager must perform to keep a company healthy and successful. Like a doctor's work is to keep patients healthy, finance managers' work is to keep a company financially strong. Function of financial management. Number 1, investment decision. Meaning, it means deciding where to put the money so that the company earns good profits. 2 types of assets. Long-term assets, like buying a factory or land used for many years. Short-term assets, like cash, stock, inventory, used within a year. Subparts, capital budgeting decisions. Deciding about long-term investments. Example, should a company open a new branch? Should a bank start a new digital service? Working capital decisions. Managing daily money needs. Example, bank managing cash flow to give money to customers daily. Key point. Good investment decisions equal high profits plus less risk. Bad investment decisions equal losses and trouble. Number 2, financing decision. Meaning, it means deciding how to arrange money for the business activities. 2 main sources. Debt, loan. Money borrowed from banks to be repaid with interest. Equity, shareholders' money. Money from people investing in company shares. Important to know, debt is cheaper but riskier. Need to pay interest even in loss. Equity is costlier but less risky. No interest, but shareholders expect returns. Key point. A good mix of debt and equity equals financial strength and less risk. Too much debt, risk of bankruptcy. Number 3, dividend policy decision. Meaning, it means deciding what to do with the profits, give to shareholders, or keep for company growth. 2 options. Give dividend. Share profits with investors, shareholders feel happy. Keep earnings. Reinvest profits into business for expansion. Important to know, if company pays good dividend, it increases share price and goodwill. If company keeps all profits, shareholders may feel bad and share price can fall. Key point. Balance is important. Some profit for shareholders plus some profit for company growth. Number 4, liquidity decision. Meaning, it means managing current short-term assets and liabilities to ensure company has enough cash to meet daily needs. Important because too much cash equals wasted money, no profit. Too little cash equals company can't pay bills equals bankruptcy risk. Example, bank keeping enough cash so customers can withdraw anytime but not keeping extra idle cash. Key point. A balance between liquidity, cash available, and profitability using cash wisely is critical for business survival. Small summary. Function. Simple meaning, example, investment decision, May. Where to put money, open new bank branch. Financing decision, how to arrange money, take loan or issue shares. Dividend policy decision. How to use profits, give dividend or reinvest. Liquidity decision. Manage daily cash, enough cash for ATM withdrawals. Real-life connection for your bank PO and manager career. In interviews, you might be asked, how would you manage a bank branch's funds? Answer, you will apply investment, financing, dividend, and liquidity knowledge to manage it wisely. In group discussions, if topic comes like financial management in banks, you can confidently speak about these 4 functions. As bank officer for manager, manage daily working capital of the branch. Decide loans, investments, deposits properly. Maintain liquidity to meet customers' cash needs. Suggest profits usage, whether to reinvest or distribute. In bank exams, SBI PO, IBPS PO, MCQs can ask directly from investment decisions, financing, dividend, liquidity topics. Easy example you will love. Imagine you are the manager of SBI branch. You decide to invest in new ATM machines. Investment decision. You plan to borrow money at low interest from RBI for loan expansion. Financing decision. You suggest the bank retain part of profits to open a new branch in your city. Dividend policy decision. You manage cash daily so customers never face cash shortage. Liquidity decision. Would you like me to continue and clearly? Heading meaning significance of financial management means why financial management is so important, how it helps the company to survive and grow. Number 1.2.5, significance of financial management. 1, finance is the controlling function, meaning every part of a business, like making products, selling them, hiring people, needs money. Without finance, no department can run smoothly. Finance plans and controls all business activities. Example, in a bank, to open a new branch, you need money to rent a building, hire employees, buy computers, everything. Finance team plans this. Key point, finance is like the heart of business, pumping funds to every department. Heart 2, aid to managerial decision areas, meaning finance helps managers take better decisions before taking any action, like launching a new service, hiring more staff, or buying machines. Managers check if finance allows it. Example, before a bank launches a new savings scheme, they check if they have enough funds to give interest to customers. Key point, finance is involved in every big decision a manager takes. 3, wealth maximization, meaning finance aims to increase company profits, increase shareholder wealth, making investors richer. They achieve this by borrowing money at low cost, investing in profitable projects. Techniques used: ratio analysis, budget control, cash flow management. Example, if a bank invests in opening branches in profitable cities, they earn more interest income equals more profit. Key point, finance equals more profit equals happier shareholders. Nash-Dagger 4, financial management is an analytical tool, meaning finance uses maths, data, and analysis to make smart decisions. Example, a bank uses financial analysis to find which branches are profitable and which are not, and take action. Key point, good finance decisions are always based on numbers, not guesswork. Thar 5, administrative in nature, meaning today, finance is not only about getting money, it also manages where to invest, how to allocate capital, approving big projects. Example, a bank doesn't just collect deposits, it also decides carefully where to give loans to earn interest safely. Key point, finance is the manager of money. Emerge 6, finance function is centralized, meaning unlike marketing or production, which happen at different locations, finance is controlled from one central place. Example, head office of a bank controls how much loan each branch can give. Key point, finance equals one brain controlling money flow. Natcheshtar 7, base for managerial functions, meaning all management activities like planning, organizing, controlling depend on finance. Without money, no plans can happen. Example, if a bank wants to organize a big marketing campaign, it first checks if finance is available. Key point, finance is the fuel for running business engines. 8, performance measure, meaning finance checks how well a company is doing by looking at profits, risk factors. This helps managers improve. Example, if a bank branch is not making enough profits, finance reports it and managers can fix the problems. Key point, finance equals health checkup of business. Quick summary, know, importance, memory. Tip 1, finance controls all activities, heart of business. 2, helps in managerial decisions. Brain for decisions. 3, maximizes wealth, profits plus shareholder happiness. 4, uses analytical tools, smart use of numbers. 5, administrative role, manages money decisions. 6, centralized function, single brain controlling. 7, base for other functions, fuel for action. 8, measures performance, business health checker. How this helps you in bank PO manager jobs. In bank PO interviews or group discussions, you may be asked how finance helps in decision making. What is the role of finance in banking? As a future manager, you will plan budgets for your branch, approve or reject loan proposals after checking profitability, ensure your branch remains profitable. Knowing financial management basics will make you confident while giving examples in interview, GD, and real work. Small motivation for you. Each small concept you learn today will build you into a strong bank officer tomorrow. Would you like me to continue like this for your... Let's start now. Heading meaning. Finance and strategy corporate means how finance supports company strategies to grow, earn more money, reduce risks, and succeed in the market. It shows how finance is connected with planning, operating, monitoring, and improving a company's success. Number 1.2.6, Finance and Strategy Corporate. 1. Finance helps in operating decisions. Meaning, finance checks and monitors the different choices managers make in daily work, like hiring staff, buying machines, launching new products. Example, in a bank, before starting a new loan scheme, finance checks if enough funds are available. Key point, finance equals helping managers take smarter day-to-day decisions. 2. Monitoring is vital for strategy. Meaning, after making decisions, finance tracks if those decisions are working well. If not, the company changes or improves the strategy. Example, if a bank's mobile app is not attracting customers, finance reports low returns and suggests improvements. Key point, finance, feedback provider for success. 3. Goal, to higher future cash flows. Meaning, when finance decisions are good and well monitored, the company earns more cash in the future. Example, a bank that invests wisely in digital banking earns more deposits and profits later. Key point, good finance, more money later. 4. Bigger role in financing decisions. Meaning, finance plays a big role in raising money, capital, at the lowest cost so that the company's value increases. Example, a bank issues bonds at a low interest rate to raise funds cheaply. Key point, low-cost capital equals happy shareholders plus more growth. Now 5, everyone must involve, not only CFO. Meaning, not just finance heads like CFO, but all managers must understand finance because every decision affects financial results. Example, a branch manager giving too many risky loans affects the whole bank's finances badly. Key point, finance, everyone's responsibility. Figure 1.1, simplified, corporate strategy, operating decisions, financing decisions. Aim, create value for shareholders, how company operates daily, how company raises money. Internal resource use, divestitures, monitor, evaluate, improve, capital risk, payout policies, increase cash flow, strategy formulation and implementation, decrease cost of capital. Finance connects all these parts together by monitoring and guiding decisions. Hash financial metrics to implement and monitor strategies. Metrics equals important numbers to measure success. 1. Cash flow. Meaning, cash flow shows how much real money a company has after paying for expenses. Example, if a bank collects EMI, loan installments, more than it gives out in loans, it has positive cash flow. Key point, more cash flow equals ready for future growth. 2. Economic value. Meaning, economic value is created when the company's net income is higher than the cost of its capital, borrowed money. Example, a bank earning 50 crores but spending 30 crores on loan interest creates 20 crores of economic value. Key point, create more value, just earning money. 3. Asset management. Meaning, managing companies' current assets, cash, stocks, and current liabilities, payments, debts efficiently. Example, a bank must collect loans on time and not allow bad debts. Key point, efficient assets, healthy business. 4. Profitability ratios. Meaning, ratios that show how well a company makes profit from sales, assets, and investments. Example, a bank measuring how much profit it earns for every 100 it lends. Key point, higher profit ratios equals stronger business. 5. Growth. Meaning, growth means increase in sales, market share, and overall business size. Example, if a bank grows its customer base from 10,000 to 1 lakh customers, that's growth. Key point, controlled growth, strong market position. 6. Risk assessment and management. Meaning, finding out risks early and taking steps to avoid or reduce them. Example, a bank checks if giving loans to risky customers will create future problems. Key point, find risk early, save company later. 7. Optimizing tax. Meaning planning business activities smartly to pay minimum legal taxes. Example, a bank setting up branches in special economic zones to enjoy tax benefits. Key point, smarter tax management equals more net profit. Quick summary. Concept memory tip 1. Finance and operations, smart daily decisions. 2. Monitoring strategy, adjust if needed. 3. Increase future cash flows, more future money. 4. Major role in financing, low cost capital. 5. All managers involved, everyone cares about finance. 6. Metrics like cash flow, economic value, profitability, track and improve. How this helps you in Bank PO manager jobs. In Bank PO manager jobs, you will take loan sanction and branch investment decisions based on financial analysis, monitor branch profitability and suggest changes, understand financial metrics like cash flow, asset management, very important for audit checks. In SBI PO group discussions, you might get topics like importance of cash flow management in banks, risk management in banking sector. You will sound super knowledgeable if you connect finance with strategy during your GD and interviews. Small motivation for you. Finance is not just numbers, it is the brain of every successful business. Mastering this will make you a future bank manager faster.